March 20th, 2026. If you rely on a paycheck, a pension, or a social security deposit to survive, that is the most dangerous date on the calendar right now. You can ignore the stock market volatility. You can ignore the political circus in Washington. You can even ignore the inflation numbers for a moment. Because none of that matters if you wake up on the morning of March 21st. Check your banking app for your direct deposit and see a notification that says funds held for review. This isn't a glitch. It isn't a hack. And if you bank with one of the 9 institutions I am about to name today, it is almost certainly not an accident. It is phase 2. We all remember what happened in July of 2025. That was phase 1. That was when the Federal Reserve finally flipped the switch on the FedWire ISO 20022 system. We saw the chaos. We saw the small business wires getting stuck for days because of data mismatches. We saw the freeze orders spike, but that was just the plumbing for outgoing money. That was about controlling how you spend. Now, they are coming for the money coming in. In the next few minutes, I'm going to talk about the documents from NACHA, the National Automated Clearinghouse Association, that create a new federal mandate starting in March. It forces banks to apply risk-based fraud detection to every single direct deposit entering your account. I will explain why this new rule, which sounds like safety, is actually a license to freeze your paycheck based on reputational risk. I will walk you through the specific dossiers of the 9 banks leading this charge. And most importantly, I'm going to give you the updated opt-out strategy you need to protect your livelihood in 2026. This is your final briefing. Let's begin with the trap. To understand why your paycheck is at risk, you have to understand who actually controls it. Most Americans think the Federal Reserve controls their money. But for your day-to-day life, your salary, your tax refund, your bill payments, the real power lies with a private organization called NACHA. They run the ACH network. That is the digital highway that moves tens of trillions of dollars a year. For 50 years, the rules of that highway were simple. If an employer sent you money, the bank had to accept it. The bank's job was just to be a mailbox. They received the letter, put it in your slot, and that was it. But starting on March 20th, that rule changes forever. Under the new risk management framework, receiving depository financial institutions, that means your bank, are now mandated to establish procedures to identify credit entries initiated due to fraud. Now, on the surface, that sounds reasonable. Who doesn't want to stop fraud? If a hacker is trying to launder money into your account, you want the bank to stop it. But here is the Trojan horse. The new rule removes the old standard of commercially reasonable detection. It replaces it with AI-driven anomaly detection, and it explicitly targets what they call credit push fraud. This means your bank is now legally required to scan the source of your incoming money. If that paycheck comes from a company the bank's algorithm doesn't like, say a cryptocurrency exchange, a firearms manufacturer, an independent media company, or even a gig economy platform, the AI can flag it as suspicious. And because of the liability shift that also kicks in on March 20th, the bank has a financial incentive to freeze it. If they let a bad deposit through, they're on the hook. If they freeze your good deposit by mistake, they face zero consequences. They just hold your money for 10 days while you scramble to pay your mortgage. We already saw the beta test for this. Think back to last summer, July 14th, 2025. That was the deadline for the FedWire ISO update. They told us it would be seamless. They told us it was just a format change to make wires faster. But what actually happened? Thousands of Americans woke up to find their outgoing wires rejected because they didn't have the correct purpose code. We saw real estate closings fail. We saw small businesses unable to pay international suppliers. The system demanded rich data. It demanded to know why you were sending money. That was the attack on the exit door. Phase 2, the March mandate, is the attack on the entrance. And just like last time, There are specific banks that are eager to weaponize this rule. We are not guessing who they are. We know who they are. Based on the debanking inquiry letter signed by a coalition of 19 state attorneys general and a forensic review of the terms of service updates that have been quietly mailed out over the last 90 days, we have identified 9 specific institutions. These are the banks that are most aggressively adopting reputational risk scoring. These are the banks that are integrating their systems directly with the new NACHA surveillance tools. If you bank with these names, you are in the blast zone. Let's start with the Big Four, because they hold the deposits of nearly half the country. Bank number 1 is JP Morgan Chase. Chase is the heavyweight champion of debanking. The attorneys general specifically called out Chase for its history of canceling accounts based on political and religious views. They cited the closure of accounts for the National Committee for Religious Freedom. They cited the sudden termination of accounts for independent energy producers. But for 2026, Chase has gone a step further. In their updated deposit account agreement, they have added broad language regarding availability of funds. They now reserve the right to delay the availability of your direct deposit if they suspect irregular activity. What is irregular? The algorithm decides. If you suddenly get a large deposit, maybe a bonus, maybe an inheritance, maybe you sold a car, that is a velocity spike. Under the old rules, the bank would just process it. Under the March 2026 rules, Chase's AI is programmed to view velocity spikes as potential credit push fraud. They can freeze that deposit, demand proof of source, and lock you out of your own money for weeks. And because you signed the new terms of service, you gave them permission to do it. Bank number 2 is Bank of America. Bank of America is taking a different but equally terrifying approach. They are betting everything on behavioral biometrics. BOA has been rolling out a system that tracks not just what you buy, but how you access your money. Do you log in at 2 a.m.? Do you use a VPN? Do you withdraw cash every Friday? The March NACHA rule gives them the cover to weaponize this data against your deposits. If the system sees that you are a cash-heavy user, meaning you withdraw your paycheck as soon as it hits, the algorithm flags you as high risk. Why? Because cash breaks the data chain. They can't track where the money goes after you take it out. To the system, blindness is a threat. So, when the new fraud rules kick in, Bank of America is positioned to flag cash-heavy accounts as potential mules. They can reject your incoming direct deposit under the guise of protecting you from being used as a money mule. Imagine explaining to your boss that your paycheck bounced because your bank thinks you used too much cash. Bank number 3 is Wells Fargo. Wells Fargo has explicitly stated in their ESG reports that they are committed to risk managing their portfolio to align with social goals. The 19 attorneys general slammed Wells Fargo for debanking clients in the firearms and ammunition industry. But now, that filter is coming for individuals. Under the new NACHA mandate, receiving banks must monitor for false pretenses. This is a vague term intended to stop scams. But Wells Fargo has a history of stretching definitions. If you work for an industry that Wells Fargo deems reputationally sensitive, say oil and gas, private corrections, or certain political nonprofits, your paycheck itself could be flagged as coming from a high-risk originator. The bank isn't freezing the company. They are freezing you for associating with the company. It is guilt by financial association. Bank number 4 is Citibank. Citi is the globalist of the bunch. Their focus is on the digital ID integration. Citi has been piloting the Regulated Liability Network. This is the prototype for a programmable digital dollar. For Citi customers, the March 2026 update is about data harvesting. They're using the new NACHA rich data fields, specifically the new payroll and purchase tags that become mandatory, to build a comprehensive profile of your life. if your income stream doesn't match the digital profile they have built for you. For example, if you start making money from a side hustle they didn't know about, the deposit triggers a Know Your Customer freeze. You will have to upload documents, prove where the money came from, and beg for access to your own earnings. But the list doesn't stop with the giants. Our investigation has flagged 5 other major banks that are quietly adopting these same Phase 2 measures. These are the ones that trap people because they often masquerade as friendly regional options. Number 5 is US Bank. Number 6 is PNC Bank. Number 7 is Capital One. Number 8 is TD Bank. Number 9 is BMO. I want to focus on TD Bank for a moment because they're the canary in the coal mine. Remember, TD is a Canadian-owned institution. We saw what happened in Canada during the trucker protests. It wasn't the police who stopped that movement. It was the banks. The Canadian government invoked the Emergencies Act, and within hours, banks like TD froze the personal accounts of anyone who had donated even $20 to the convoy. They didn't need a court order. They just needed a list. TD Bank has already proven they have the infrastructure to execute a mass political freeze. Now, they're importing that same architecture to their U.S. branches. The March 2026 NACHA rule gives them the legal cover to use it here. They won't call it a political freeze. They will call it a risk management action under the new fraud guidelines. The result is the same. You have zero balance. And if you think this is just paranoia, you need to look at what is happening internationally. The U.S. is actually late to this party. Look at Nigeria. Nigeria was the test lab for the war on cash. In 2023, the Nigerian government decided to force the population onto their central bank digital currency, the Naira. But people didn't want it. They preferred cash. So what did the government do? They didn't make the Naira better. They made using cash impossible. They imposed a strict cap on cash withdrawals, equivalent to about $45 a day. If you had money in the bank, you couldn't get it out. If you wanted to buy food, you had to use the digital system. The result was total chaos. We saw riots in the streets. We saw people setting fire to ATMs. We saw a complete breakdown of the economy. But here is the scary part. The government didn't back down. They viewed the riots as the cost of doing business. Their goal was total visibility of every transaction, and they were willing to burn the economy to get it. That cash cap in Nigeria, that is exactly what the suspicious activity flags in the U.S. are preparing us for. When Bank of America flags you for withdrawing cash, they're implementing the Nigeria model. They're training you to stop using the one form of money they can't control. So, why is March 20th the tipping point? It comes down to the liability shift. In the banking world, liability is everything. Before March 2026, if a fraudulent direct deposit hit your account, the liability was mostly on the sender. Your bank could say, "We just received the funds, we didn't know." But the new NACHA rule shifts that burden. It says the receiving bank must have commercially reasonable procedures to stop it. This creates a massive incentive for the banks to over-police you. Imagine you're a bank executive. You have 2 choices. Choice A, you let a deposit through. It turns out to be fraudulent. You get fined by regulators and lose the money. Choice B, you freeze the deposit. It turns out to be legitimate. The customer gets angry. Maybe they complain on Twitter. But you lose $0. Which option do you think the algorithm is programmed to choose? It will choose freeze every single time. You are just collateral damage in their compliance strategy. They're shifting the burden of proof onto you. In the old system, you were innocent until proven guilty. In the new system, your transaction is suspicious until the data proves it is legitimate. This is the end of financial privacy. Period. So what do? Panic is not a strategy. Action is. You have a narrow window of time before the March enforcement kicks in to restructure your financial life. You need to build a parallel banking strategy. This doesn't mean you have to hide money under your mattress. Though having some cash there isn't a bad idea. It means you need to move your operational capital away from the blast radius of the Big Nine. Here is your 3-step survival guide for 2026. Step 1. Fire the big banks. If you have your primary checking account with Chase, Wells, BOA, or Citi, you're sitting in the ejection seat. You need to open an account with a local credit union or a small community bank. Why? Because small banks and credit unions are often exempt from the most aggressive Phase 1 filters of the NACHA rule. The largest banks, those with over 10 million annual transactions, are the ones mandated to enforce this first. The smaller institutions have a longer runway. They're not under the same microscope yet. More importantly, a credit union is member-owned. They answer to you, not to Wall Street shareholders who are terrified of regulators. When you walk into a local community bank, the branch manager often has the authority to override a freeze. At Chase, the branch manager has no power. The algorithm runs the show. Move your direct deposit. Move your automated bill payments. Get your life off their ledger. Step 2. The push strategy. This is a tactical change in how you pay bills. Most people set up auto pay where the utility company or the credit card company pulls money from your account. That is dangerous in this new environment. If a pull request hits your account and the algorithm flags it as unusual, maybe the amount is higher than last month. The bank rejects it. You get hit with a late fee, your service gets cut off, and your credit score tanks. You need to switch to a push system. You log into your bank and you send a payment to them. When you initiate the transaction, you are validating it. It is much harder for the bank to claim fraud when you're the one pressing the button. Revoke the auto drafts. Take back control of the timing. Step 3. The physical buffer. The banking system is becoming a digital turnstile that can lock at any moment. You need a physical buffer. I recommend keeping 1 to 3 months of living expenses in physical cash. This is not for the apocalypse. This is for the algorithm glitch. If your account gets frozen on March 21st because of a false positive, it will take at least 10 days to resolve. Can you buy groceries for 10 days without a card? Can you put gas in your car? If the answer is no, you are vulnerable. Go to the bank. Withdraw a little bit each week. Do not do it all at once. Remember the structuring laws. Just slowly build up a reserve that is outside the digital system. And finally, step 4, break the silence. The system relies on your silence. It relies on you being too busy to notice the walls closing in. It relies on you deleting that email update and thinking, it won't happen to me. But look at the map. Look at Canada. Look at Nigeria. Look at the terms of service updates from Chase and Wells Fargo. It is already happening. The only way to fight a digital prison is with information. You need to become the media. They don't want you to see this. They want you to stay asleep until the gate closes on March 20th. Don't give them the satisfaction. If this video vanishes tomorrow, you need to have already shared it. If my channel gets struck for showing you the documents the news refuses to cover, you need to already be subscribed so you can find us again. We're building a lifeboat here. Make sure you are on it. Hit the subscribe button, not just for updates, but as a signal that you are awake. Share this video with every person you know who banks with the Big Nine. The clock is ticking. I'll see you in the next briefing.